Awesome. Hello, everyone.
Hello, everyone, and welcome to the Thursday night edition of SteamYard Crypto Fireside Chat. I guess we'll go around the panel here and everyone introduce themselves. Carol, can you give us your background and what brings you into this industry and what's going on?
Sure, thank you. I'm Carol Van Cleef, and I wear two hats. One is a lawyer with the law firm of Bradley, Aaron Bolton Cummings, as well as the CEO of Luminous Group, a blockchain consulting group. I've been in and around the space of crypto since 2012, 13 timeframe, and have seen a lot and have worked on a lot of different kinds of projects with a specific focus in the area of the cryptocurrencies as currency and in the anti-money laundering and KYC area.
Okay. And I guess we'll go with questions afterwards. But Matthew, you're what gets you into the industry here?
Yeah, I think my background I've been in finance and technology for almost 2 decades now combined, and I think my real interest probably started with the early days of Bitcoin around 2011, and I saw it as a technology was really interesting, but I didn't understand until probably 2014, 2015, how this could actually, how I could see this actually being applied to my world that I knew in finance. So I've worked with a lot of different systems around compliance, back office administration, things along these lines. And then since starting iComply, we've had the opportunity to be involved in some of the FATF committees around virtual assets service providers, travel rule, digital identity. And a lot of our focus now in the space is how do we really provide technology and tools through iComply to help to bring assurance or integrity into different transactions and who's behind a specific transaction, making sure that they actually have the ability to demonstrate who they are so they can actually transact and use this technology.
Gotcha. Okay. And Peter, we meet again from a few weeks ago.
Yes,
you want to fill us in again on what you're doing in the space?
Yeah, so I'm the co-founder of Ronin AI. Ronin AI is pretty much a combination of blockchain and artificial intelligence. So we're trying to make smart, sophisticated AI predictions regarding cryptocurrency and digital assets. And on the side, I'm also consulting large corporations, government projects, startups, etc., on the blockchain implementation. And I also have experience consulting certain countries on digital currencies for the nations. So today's topic of stablecoins is probably going to be very, very relevant for that discussion.
Gotcha. Yeah, I'm looking forward. I'm planning to learn a lot here on stablecoins, that's for sure. And Joel, your background and what brings you to the space?
Complete accident. I had the fintech and blockchain practice at a global law firm called Sullivan & Worcester, and I really did get into this space by accident back in 2014 when I got asked if I could help Overstock issue and trade a security on the blockchain, and I first had to go home and figure out what is blockchain, and then spent 2 years working on that project, especially working with the SEC and FINRA to get them to ultimately approve the issuance, and have been kind of sucked into the black hole ever since.
I remember when
once you're in, you can't get out, by the way.
I remember when the Overstock ICO came out, and still, I'm still planning to learn a lot here because my knowledge in that space is still pretty limited here. My background, Peter and I met before. Matthew, I don't know if you and I, our backgrounds, if we've crossed paths, but my background is foreign exchange trading for 20 some odd years. Started out at the banks in the 1990s in spot FX. Moved to the buy side in 2000, where I ran some systematic medium frequency models in foreign exchange. Then got more into the high frequency space in 2009, 2010. Pure HFT type stuff. Was at a very large, one of the well-known HFT prop firms for a number of years, where I was working on liquidity and sales distribution and things like that. And then left there, worked at a little fintech company, Seabury, where we're associated with. We work with some custodians and some fintech solutions for the space. That's what sort of introduced me to crypto. Now I work for Floating Point Group, which is a bunch of really smart. We run a lot of algorithms and execution algorithms, connectivity, liquidity, direct market access. And we provide that solution to the space. And I sort of fell into to crypto as well. Just the last company I was at, and I'll just say, one thing the crypto space has done is give us old time FX guys another market to get involved in. We're sort of outgrown FX, and yeah, we got crypto now. It's BTC, USD, EUR, USD. What's the difference? But what I've come to find out recently is there's a besides the price going up and down on a screen, buying or selling that is one thing, but everything that happens after you do that trade is operationally difficult compared to the traditional asset markets. And my learning curve on that has gone up tremendously the past couple months. So I'm looking forward to today's discussion and see how people are doing things.
By the way, there are a lot of us former structured finance and derivatives guys now in this space. I think it's a natural evolution going from those types of transactions to this stuff.
Mm-hmm.
Yeah.
Well, I was just curious, Churro, would you say, like you said, it's operationally more difficult? Is that you mean you as an end user in the space?
Well, if I'm an individual and I just have X amount of dollars and I want to just open an account and buy Bitcoin and go short Bitcoin, yeah, you can go to any of the exchanges, any of the perpetual contracts, the derivative exchanges. It's pretty simple for me. But if I'm an asset manager, a hedge fund, CTA, and I'm used to the traditional prime brokerage, one of the big banks, where I run, they do all my fund administration, they do all my, prime brokerage, my clearing, they run all my NAVs, and everything is kept within one ecosystem, and they cross margin. For them to get into the space, I'm running into this question more and more from that type of industry. That's where all my, a lot of people I know work, and they're very interested in getting into crypto. It's the same pushback I'm getting. How does it work? Where does my money go? What's the security? Who am I going to get hacked? Is someone to steal my coin? Or if I have coin, things like that. And that is one of the biggest things that's I think, in a sense, preventing traditional asset managers to get into the space.
Especially when the answers to questions like that are usually it depends. So, and really,
it's tough. I mean, we can delve into that, but one of the things I wanted to start off with is we had one of these sessions, I guess, a few weeks ago. Myself and Peter were on it. And it was running, almost a couple hours, and we had to cut short because people had some commitments, and we left it on the last thing we left the session on was stablecoins, and we kind of left it as, well, we'll leave that for the topic for the next one. Well, so this is the next one. So now we're on to stablecoins, and which brings, I think, Carol and Joel really into this topic. And like I said, I know what a stablecoin is. I hear it spoken all the time, but Carol, if you want to jump in here first, if I'm at a barbecue and you're there and I'm talking to you and you say, well, I'm in the stablecoin side of things on the legal side, and I go, what's the stablecoin? Explain to me what a stablecoin is and what I should do.
That's one hell of a barbecue.
You can start with that.
Yeah, where will you find one these days?
Stablecoin mistakes.
Well, I think I heard Joel do a presentation about a year ago that I think was a great introduction to stablecoins. Is that when you start talking to people about
Yeah, no, I will. I just want to go through interest, and I'll go with stablecoins, and I'll get there.
hello. Okay.
Yeah, sorry.
When you ask people why aren't you involved with crypto? Why aren't you buying crypto? And you wait for the answer to come back as, well, because it's too volatile in price, or it's not backed by anything. That sums it up right there for stablecoins, is that stablecoins are intended to bring stability to price. So when someone buys one, that they know what they're getting, and they have some fairly good idea of what the value is going to be into the future. Likewise, depending upon the stable coin, and I think Matthew just made the comment, it all depends, that there are different ways of achieving that stability. And one way is by having some sort of backing or collateralization of the stable coin. And that then gives it an added level of stability, because you actually have some sense that there's value backing it in some way or another.
You said you know what it is, but I'll tell you what's interesting about that. So the Financial Stability Board just issued a consultative paper on stablecoins and how to approach regulating them from a global standpoint. And so I was on a call earlier today with a trade group that's going to prepare a response to their paper. And we spent probably a half hour debating the definition of what is a stablecoin. And so it actually is not that clear. And you could, depending on how you define it, for example, you could look at a money market fund and say, well, that's an interest that, where the value is supposed to be $1. And so is that the equivalent of a stable coin? So, I mean, we kind of know at a very, very high level what it is people are trying to do. But when we get down to the weeds and figure out what they really are, it's not so easy, because the concept of stable is a relative concept. So stable to what? Stable how much stability, and if you're pegging it to $1, well, to the extent you think $1 is stable, then I guess the coin is stable, but it's, it's not so black and white, actually.
Well, we could peg it to the WTI crude if we really wanted some stability.
So, get negative pricing there.
There's no question. Joel hit it on the head, right, with his comment that there are really a lot of different flavors, and in a lot of ways, the imagination's the only limitation on the kind of stablecoin that one can create. As I said, it could be collateralized by an asset. What kind of an asset? It could be fiat. It could be a metal, gold, silver, that type of thing, or it could be some other kind of asset. It could be a tangible or intangible asset. So right there, and then there's a difference between being backed versus being collateralized. So there you've got major branches, and then when you start to introduce this whole concept that, well, we can just do it with the math, create the stability with math, then God knows how many algorithms you could have to create stability.
Let me give you another way to think about it, maybe, that if we put aside how somebody's going about trying to create so-called stability, the outcome is that either people are going to accept whatever it is you've created as a means of payment or as a store of value. So if the market is willing to accept whatever the it is, to use it for payment or to store value, then you've, by reverse engineering, created something that is, quote, stable enough that makes people willing to accept and use it.
Well, and I think there's actually a comment in the thread here that's, sorry, go ahead.
I was going to say, but who's going to be the end user? I'm just very curious. I mean, as a retail person, I mean, who's going to be the end user and have demand?
It depends on why you're creating the stablecoin. I mean, you can try to create something that's intended ultimately to be used for the retail market. And I mean, real retail is to walk into a Starbucks and use that stablecoin to buy a cup of coffee. Or you can create a stablecoin that's intended to simply facilitate and create a more efficient wholesale or interbank type of payment system where, the last thing you're doing is trying to bring it down to the retail level. So it really depends on what your goal is.
Yeah, there's, Societe Generale has just done a couple of Ethereum-based transactions that is essentially a credit note from the bank to the bank. It's valued in euros. It's arguably a stablecoin. The whole concept of the representation of value, and I think one of the things about stablecoins is they're kind of allowing the democratization of a network of trust. So previously you may have to look at a massive corporation, publicly traded, et cetera, has a lot of audits and reviews, et cetera, being done, listing multiple countries, or you have governments that have currencies. These are all assets that people put their capital into and hope to extract it for equal or higher value in most cases. And depending on if they're using it for a payment or if they're using it for wealth accumulation. But I think when you're getting into the concept of stablecoins specifically, it comes down to kind of the concept of an IOU at the end of the day. And there's some party involved in that network that's starting to put some guarantees behind that IOU. Because if everyone's seen the movie Dumb and Dumber and they open up a briefcase of all these IOUs, it's like, what good are these actually until you know that you can trust what's kind of behind that network, whether you're trusting the mathematical algorithms of how they're doing it or the assurance and auditing procedures. I would say in a lot of cases, I hope in today's modern era that there's both involved. But I think, from the end user application, within 3 to 5 years, everybody will be using some sort of stable coin. There's an argument that what happened in Kenya with the use of M-Pesa, is a stablecoin application using cell phone minutes. And that was, that's 5-6 years ago when that pilot completed. So I think we're seeing a lot of things like telcos looking at tokenizing across their networks, or private banking applications and creating private networks. Things like Libra, as an example, is just a group of organizations all agreeing to say, hey, we're going to work together and trust in each other in this network. Once it goes live, of course.
Matthew, you're referring right now to stable coins in theory or actual stable coins in existence? Because right now it sounded like there's a novel how it should be done, but nobody's really doing that. No offense.
There are stable coins already.
So
definitely.
Yeah. So what the stable coins that I was just now? What is the? I mean, is Tether a stable coin?
What's the definition again of a stable coin? And what are the risks of the stable coins?
Gemini coin is stable coin. I mean, educate me here. I mean, it's so. Why would somebody take I don't know, the hedge fund returns and make a stable coin around a hedge fund return, or take some asset and back it by gold or something and say it's a stable coin?
You can in theory. In theory, you can. I mean, but so take something like True USD. They've created a digital coin that's backed 1-to-1 by dollar. And so you have to start number one. Do you think the dollar itself is sufficiently stable that it's something that you would use as a form of payment and as a store of value? And I think the answer, at least we could have a hypothetical debate about where the dollar is going, but as of now, I think people would still say yes. So if you simply create a digital representation, or the way I like to look at it is almost a warehouse receipt in that case, where one coin gives you the right to that one underlying dollar. Now all you're doing is saying, well, look, maybe technology has created an opportunity where it's easier to transact in that digital representation of the dollar in certain scenarios than to transact in the dollar itself. And so if we agree that the technology is such that there are use cases where people would rather transact in the crypto version of the dollar, then all we've done is created another way to transact or to invest in the dollar indirectly through that digital representation.
Here's a question. What's the difference between me transacting with a credit card versus me transacting in True USD in the current realities? And which one is better for me as a user who has no idea what's going on? I'm not a decentralized junkie. I'm not a blockchain enthusiast. I'm just a random schmuck.
I think that's a great question. And in fact, that's something that I know a lot of us in the space talk about all the time. And if I'm a consumer, the answer is there is no difference. I don't give a damn. Again,
except credit cards are better. Except credit cards are better and actually more stable.
Well, I mean, I don't give a damn from the standpoint of unless, for example, one approach is cheaper, one approach is easier for me, and and otherwise I'm agnostic. And so one of the ways to think about stablecoins is that right now we've got payment pipes. So when you walk in again to Starbucks and you hold up your Starbucks app, assuming that we can someday go back into Starbucks again, that app right now allows you to buy your coffee, and it's linked to a credit card, a debit card, a bank account, and you don't really care. You don't know. All you know is that you've been able to buy the coffee and something got debited. If a stable coin allows you to do that same transaction and can be done more cheaply, potentially more efficiently, and perhaps eliminating some of the intermediaries that have to get involved between you, Starbucks, the credit card company, and your bank, then people will ultimately be using the stable coin instead. But the big ifs are whether or not it is more efficient, whether it's cheaper, whether it potentially eliminates some of the intermediaries that are dragging costs out of the system. And if not, then people are going to stick with our current legacy approach.
But then the question is, on the origins of the stablecoins, and why do we even need to have them in the first place? What are we really trying to change here?
Well, so for now, right now, as opposed to where we go with this, right now, if you are already invested in crypto, so you're invested in Bitcoin or Ether, and you are worried about the volatility of those two asset classes, one of the use cases of a stablecoin right now is it allows you to create a hedge, but stay within the crypto world in creating that hedge. It's much harder to create a hedge outside of crypto to hedge a crypto. So trying to hedge crypto exposure in fiat is difficult. So one of the earliest cases of a stablecoins, at least, is to create hedging instruments to allow you to moderate the exposure that you have to crypto assets that tend to be more volatile.
Question again. If you do not trust the US dollar, so here's the thing, right? So I'm going to throw not the institutional side of things. I'm going to throw the blockchain enthusiast, believer, BTC maximalist, although I'm not any of those, point of view, right? So if I do not trust the US government, if I do not trust the USD, why the hell would I invest in Tether that is backed up by USD? And it's backed up by USD in such improper fashion that it's more riskier for me to actually hold Tether as opposed to just holding USD.
It's your own decision. If I could, as an example, let's say around December 25th of 2017, had you decided that you wanted to hedge your Bitcoins and put half of them in Tether, even though you didn't really like the US dollar, by March you would have felt like a genius. So there's many applications. I think people can kind of.
It's not really.
It's a tool,
It's not really answering the question. I mean, first of all, it's still a tax transaction. I would still have to pay tax because I would still have to sell out of. So I'm not forbidding anything from the existing solutions because existing solutions are all super centralized still. So what am I getting out of this?
Well, but I mean, that goes back to the original thing that I was saying, which is the concept of stable is a relative concept. Mm-hmm. So if you are trying to invest in an asset class that you think is neither going to depreciate or appreciate too much, and you otherwise are interested in crypto-related investments, then you might look at a stable coin as being an interesting asset class to help manage other aspects of your portfolio. But then, assuming that you're willing to go down that road, you still have to make a decision that you like the way that stable coin is created vis-a-vis what it is pegged to or linked to, or how it's getting its so-called stability, and you have to be comfortable with that. And so if you don't like dollars, if you peg a
stable coin to gold, if you peg a stable coin to gold and gold goes up, what happens to the price of that stable coin? If you peg a stable coin to oil, so it's just gonna track the okay.
Yeah. The concept is very similar to the concept of even a mutual fund as an example, where you say you're going to buy 1,000 people are all going to put in 1,000 shares. All of a sudden, you have a pooled asset worth $1 million. And that could be $1 million of cash. You could buy gold with that million, and then if the price of gold goes up, everyone's share is equivalent. I think, in some ways, one of the primary applications.
I think if I could interrupt, I think we are talking across a number of different concepts at one time, and it is very important to unpack that. Stable coins is a term that came in, was used, the first term to be used, a lot like Bitcoin, and it becomes the dominant term. As we've all said, there are a lot of different kinds of stable coins, whether it's the underlying asset or stability mechanism, it's the investment mechanism, a whole host of different features that make up these coins and require analysis. So when you're looking at it from a potential investor standpoint, or user, I mean, some are going to be for investment purposes, maybe. A lot of them are just for plain use. What kind of use are they going to be used for? And when you start to break that down, you really have to start to dig deeper into the different elements of the coin, and Absolutely. To the point of why buy into it, why tether when if you don't have confidence in the U.S. dollar, if it says it's backed by the dollar, but it's only backed by 40 cents on the dollar or 4 cents on the dollar or whatever that number might be, why are you still using it? It has a purpose and it's serving a purpose for people who've decided they want to use it. Should people be more knowledgeable about what they're buying into? I guess until we have our first really big bust on a stable coin that causes people to say, hey, I need to learn more about that stable coin. I think as time goes on, as we see, this category of financial instrument or financial management tool become more widely adopted, I think we're going to find the user become many users, I won't say all of them, but many users become more sophisticated in what they are buying and what they are putting their funding in, even if it's for a very short period of time.
But Carol, would
Absolutely.
you agree? Would you agree, Carol, that this is just a temporary marketing solution? Those stable coins, the whole aspect of stable coins, because it's being pegged by the stuff that needs to be replaced in the first place.
That's if you believe that you're going to replace all fiat currency, though.
Well, what if you
I think, and there's a difference between having an additional asset class versus the concept that one asset class is going to wipe out all other asset classes. There's too much opportunity across all sorts of asset classes. Why would I? What if I can't have lumber tomorrow because we decide to destroy that asset class and there's no more lumber? That's not just a financial category. Bitcoin is a digital asset. There's all sorts of economic value from these other asset classes.
Yeah. So if you don't,
Matt, that brings up a good point here. Joel, you mentioned your structured products before, right? Or involved in structured products before falling into crypto. I have a couple of questions. One, it sounds like a lot of these, you talk about lumber and talking about different commodities or different assets backing a stable coin. Then you got to structure that product, structure that coin. And then if you truly have a stable coin, why do some stable coins pay 8 or 9% interest, right? If you have a stable coin pegged to $1, how come the 1 year forward is 91 cents or $1.09 if you're borrowing or lending? And it kind of seems to me that it has like a structured product feel to it. And I think in a lot of these coins get rehypothecated back in the day, like the global financial crisis, things get sold, they get sold. And next there's a break in the chain somewhere because it's been lent out and borrowed too many times and something goes wrong. I mean, with your background and I mean, how do you if you want to touch on your structured product background and how that relates to this and if there's any similarities there, I'd be curious.
Sure. So, no, it's a great analogy. So one of the products that I worked on in the past were called principal protected notes or principal protected products, where you would use a combination of an underlying pool of assets combined with some types of derivative overlay to create an instrument that was intended to maintain a stable floor price with a potential upside tied to the underlying assets. And so those products gave you potential upside, but were structured so that you wouldn't lose your principal exposure. So you could look at certain stable coins as being similar to that. And the interest part that you mentioned is part of the component that are used by some stable coins to create the stability. In other words, there are stable coins that are structured so that the longer you're willing to hold that stable coin, they're designed to in effect reward you through some type of interest payment that's equivalent to a bank deposit. And they do that through, in effect, a leverage strategy that the more people that lock up the stablecoin and aren't trading it, the easier it is for them to create the stability and potentially create an upside return beyond the floor price. And so it is very much like a structured product in many ways, but it's just a digital version of that structured product.
Yeah, and with
stablecoins could come unwound like a CDS or something in the 2008, I should say, and one day it's stable, the next day it's 20 cents. What? Yeah,
that's good. That's very good.
Well, I've said for a while now that as we're getting further and further into this area, and if we want to use the term stable coins, it's really financial engineering. And as more people become aware of what the capabilities are with this technology, I think we're going to have financial engineering that's going to so far exceed anything that we saw leading us into the 2008 financial crisis. So again, I go back to understanding what we're dealing with and in what context, because it's going to affect a lot of things, including how it's treated from a legal and a regulatory perspective, because some of these stable coins are really just another form of currency, but others are true securities. And then we've got some that are probably in between, and then we may have some that are something entirely different. So again, these are great conversations, but unpacking them to understand exactly what we're talking about in the context is very important.
Can I suggest a slightly different way to also think about it that might help? Is that one way to look at stablecoins are as an asset class that one invests in. And then we can have the debate just like we've been having. But a second way to think about stablecoins is that, again, if we look at payment systems and payment processes, part of the argument, or at least one of the potential use cases for stablecoin, is over time to create a more efficient payment pipe system in which one vendor is going to pay another vendor. And right now, that system, again, is not always very efficient. It certainly drags a lot of costs that people charge. And so if we can use a smart contract, which again, so we're talking about stable coins, but at the end of the day, it's a smart contract, a software code that's going to allow two parties to process a payment transaction on a blockchain. If we can use that smart contract that we can call a stable coin to allow party A to pay party B without worrying about price depreciation or appreciation above a typical range while that transaction is being processed, and if we can process the volume of payments and do it quickly and more cheaply than our existing pipeline systems, then that's the other way to think about stablecoins. All it is a new technology to process payments.
So it's a new banking ledger that really everyone has access to. In one sense, if it is and it doesn't have to be on a public blockchain, but for most applications that we see, and I think that's one of the areas where we saw an early use case was. Jolie mentioned at the beginning, I think, the concept of being very similar to the concept of a money market fund, which, I remember back in my broker days in Canada, we weren't allowed with our licenses, weren't allowed to have a cash accounts. So they had to create these products that were very cash-like, that you can move funds in and then start deciding how do you make your trades into an actual, let's say, stock or fund type of investment. And I think that's in some ways very similar. Those rules have changed for over a decade, but here in Canada, but in some ways very similar for the digital asset industry, where people just wanted something to. I remember sitting at a bar at a pub in Vancouver here that had a Bitcoin ATM, and my friend went and wanted to buy some Bitcoins and came down for a beer afterward and said, "Hey, I bought my first ones. I'm going to go check the balance on this Bitcoin ATM." And he came back to the table and he goes, "They charged me like $140 processing fee for $200, and I'm already positive." and there's no stability at all. And so when people are moving their money first into a digital asset class, I think that was one of the first use cases. I think we're now moving beyond that. We see a lot of new use cases. And I'd be curious, Carol, like you've mentioned a few times, what are some of the use cases that you guys see as promising going forward?
Well, I think we're already seeing the use of it from a payments perspective. The Facebook Libra project is certainly a good example of that. I think Joel's also underscored several potential use cases. We're seeing it developed as a tool for treasury management for internal movement. What JPM is putting together is a cross-border payments system to deal with friction in another area of the system. Whether you're looking at some that are going to be developed for strictly investment purposes, I guess the question I have is a true stable coin. If it's maintaining price stability, does that mean you want to make that an investment vehicle for the future where purportedly you're going to be making money? I think it's interesting when you start combining the stable coin with income producing properties, because again, it raises a different set of issues that one needs to think about in looking at them. But again, I think that it's technology, and it's technology that if you find a need for it, that it can be used in very creative ways.
So I'm going to jump in here. So I was about to ask a question, and thank you, Matt, for answering that question, because it segues into this. And Carl, I was going to say, what's going to drive the adoption of this? And I'm going to go, Peter mentioned earlier, am I going to use my credit card, or I'm going to go buy a stable coin? Quite frankly, I'm going to use my credit card until, if you go to, a Dave and Buster's arcade, you go there and you get a stable coin, you give them $20, they give you $20 in tokens that you have to use there, right? I can't just go in and put my $20 and go play the games. So is it going to be driven by Amazon or Walmart saying, hey, you know what? We're not taking dollars anymore. We just launched the Amazon stablecoin. So everything you buy in our network globally, you got to use this coin. So you're forced to go change your $20 into $20 in Amazon coin, or Walmart for that matter. Or is it going to be driven by demand from retail people going, you know what? I don't want to hold dollars anymore, and I want to own this stable coin. So I'm going to demand that Amazon and Walmart price things in stable coins. Quite frankly, I think it's going to have to come from the industry, in a sense, forcing us to go in that direction. But maybe I'm wrong. What do I know? Anyone have any thoughts on that?
I think Libra is our case in point, and I think the reason it is so frightening to so many is that conceptually it's being put together in just the right kind of way to drive adoption of a currency. If you look at Bitcoin still doesn't have the kind of adoption that warrants it to be a real true currency. But what they've put together with Libra, between the economic power of Facebook and just putting an Uber at the table, and obviously some of these examples are a little distorted today because of the world we're living in at the moment. But if you put Uber into the mix, you put Lyft, you put players that are already in the gig economy that are used to doing transactions electronically in some form or another. Just think about how you drive adoption. If, let's say, Uber one day sends you an email or a text or whatever, and it says, you've got 5 Libra in your account. We've just given you 5 Libra to use on your next trip. Are you going to use it? Most people that I say, yes, I will definitely use it because you
you raise your wallet, because again, the majority of the stable coins right now are absolutely useless. You guys are referring to them as currencies. They're not. They're just securitization. Everybody here is just happy. Oh, we have stablecoins.
So Peter, tell us how you really feel.
There's a pool of
How you
cash.
really feel about them.
There's a real pool of cash. It has been securitized, and all of us here are clapping and saying, "Whoa, there's real adoption. There's real technology." Okay, so how about we securitize bullions of gold? How about we securitize real estate? Like, why are we not so excited about any kind of securitization? A. B. Why is it back to USD? Like, why that is so important to even be considered?
Well,
So,
I think we're talking about two different things here, though. One side, we're talking about broader securitization, and I completely agree. A stable coin is, it's like we said at the beginning, it's a money market fund. I don't think
They're not
anyone's disagreeing with you.
they're not currencies.
I think, yeah, but it's not.
And
I
then
would argue
currencies because
against the
there's no
currency
community.
thing personally.
There's no
but
community behind them, and that's why they will never become currencies.
No,
Because
but
stablecoins is
I don't think
an easy
we're
way.
arguing for
Doesn't have
them
to
to
be.
become currencies.
It doesn't have to be.
Yeah.
Again, at the end of the day, look, there's some practical limitations right now, right? We're talking about financial transactions, and blockchain technology is limited in how many transactions we can process in any second. And so if we want any stable coin to really be used as a payment system, that's not going to happen until blockchain technology continues to evolve so that the volume of transactions that can be processed increases and the cost per transaction decreases. But assuming that happens, then we get to the point in time where you have a debit card. And if your debit card is linked to a stable coin versus a dollar, you don't care if you can go in and use that debit card, and being linked to a stable coin is cheaper for you, and the vendor is still getting paid in the dollar that they want to get paid in. Then we start to, again, look at stable coins as a better payment system that's more efficient and cheaper, and that's what ultimately helps the adoption of it.
Centralized systems such as Visa will always be more efficient than any centralized systems like stablecoins.
Visa's already and MasterCard are already using blockchain networks and have for several years.
Private private permissioned. They're not public. They're not blockchain networks.
Doesn't matter. Well,
No, these are DLTs, guys. These are DLTs. They're not decentralized. They are DLTs.
100%. 100%. I don't think anyone's making these claims. But I think when we're looking at the concept of, if we're looking at this from the perspective of the application of the technology, there's many applications. Some of the ones that Carol was mentioning before, but for the user, like, is it going to come from demand or supply? I think it's both. Like, I don't think corporations are going to force people into stable coins. I think they're going to entice people through convenience. And Carol's example of, hey, if you have $5 worth of Libra or five Swiss francs worth of Libra in your wallet, and you happen to be on your way to Zug, are you going to spend it? And it's probably not even going to ever show up on your card as much as on your Apple Pay, your Google Pay. It's just going to be, you'll have a wallet within these systems, and we're very close. In fact, all of the things in Apple Pay, Google Pay are running on Net1, like MVC blockchain technology. So it is, the infrastructure is one step away. But when you're talking about, would I pay with a stable coin, or would I pay with Bitcoin, or would I pay with the US dollar? I've paid with all three, and when we were in Malta, a client of ours as a payment processor, and at a restaurant, you can just literally tap your wallet and pay for your bill. You see what N26 is doing in Germany, or Bank Frick in Liechtenstein, a couple of the banks in Switzerland. There's Signature Bank in New York. There's a lot of people that are using blockchain technology for
DLT,
stable value. No,
DLT.
Ethereum,
Let's please use
Stellar,
DLT and blockchain.
Ethereum technology, and they're using it in a way where they're creating a more open banking system with it. I think it's a building block towards.
And how is that working out so far with all those millions of dollars of investments for years? How is that working so far for those banks?
Really well. N26 is making waves globally. They're winning awards.
Maybe winning awards by whom? Winning awards by whom? The awards are presented by the banks, by the other banks, right? So they're winning awards of the other 19 banks.
Yeah.
Let's face it, guys. Here we need to either get the market share of the real user who wants decentralization, or is just yet another centralized system that nobody should really care about from the perspective of true blockchain technology. DLT, fine. It's just a database. Amazing. Like, come and the common guys are saying the same exact things.
What difference does that make if at the end of the day stablecoins become a more efficient and cheaper payment system? Why do we care whether we're talking about true decentralization or something else? We're just talking about a better way to process payments.
Because in this situation, everything is so much more controlled. You guys are becoming so much more controlled, all of us, because now it's a closed network. All the money is there. So there's huge risk. Again, from the blockchain enthusiast point of view, there's a huge risk. You guys are trying to solve the immediate issue of being able to make inter-country transactions over the weekend. Fine.
No, but you're right.
Cheap.
If there's more risk, it's not. It's by definition, if we're creating more risk, then it doesn't make sense. Part of the use case has to be that it's cheaper, more efficient, and it's at least it's not increasing the level of risk and hopefully reducing risk. And so I agree with you. I mean, if it's more risky, of course.
So what's the point?
I do think there's a really valid concern, especially with seeing some of the concepts around Libra and some of the central bank currencies as a tool of surveillance. And so I agree that there's, from a privacy and a protection perspective, some of these stable coins, they're going well beyond things like AML and going into, if you imagine an economy where you can purchase everything with Libra, how micro-targeted will those ads become in Facebook then? Just as an example.
Tell me one good stable coin. Name me one good stable coin and why. And I'll tell you 20,000 risks.
Everyone name their favorite stable coin. You want
usage and market acceptance? I guess the numbers for Tether would say it all. Now, does that mean it's necessarily the best designed? So I think when you start talking about again, we've got multiple threads going on here. If you're talking about something being used as a currency and adoption, what is it people want in it and how is this being used? If it's being used for investment purposes, what are the critical elements there? If it's an alternative structured finance product, again, it's going to be dictated by what's the best product in the marketplace for people to use.
Oh, right.
Absolutely. I think we're kind of it's almost like arguing, okay, well, we have these, paper ledgers, and now we're saying, well, what's the advantage of using Excel? Well, first we have to just get the adoption and actually, have the more people you have using this technology, that's when you start having the network effects of the benefits as well. People who are using it today are using it for very specific applications. Over time, we might see that. I think we'll see people use a lot of different stable coins for different applications. I'll have one from my cell phone provider that holds my account balance there. If I want to sell those extra minutes to somebody in another part of the world, I can easily just do so. And are those stable coins? They're denominated in my local currency. So for me, if that's where I'm paying my bills in, it feels stable. And so is it somewhat marketing? Yes, but all of finance is about the trust that we put behind it. So, we can call them safety coins or stable coins or what have you. But at the end of the day, it does come down to the architecture behind it and the quality of what's gone to, behind the rights of ownership as well as the technical security.
So at the point,
sorry, Peter. We have a few other topics that we need to sort of get to. We can discuss this all night, it looks like, and I don't know if we'll come to any kind of unanimous decision by any means. But yeah, we're going to say, Peter,
we have this unique opportunity to reclaim freedom from the central banking system, and instead we want to sell, pardon my language, fucking cell phone points. For God's sake, with all due respect, we either going this way or that way. We're either going the freedom way or we're going the bullshit corporate way. And the bullshit corporate way is only going to give more risks that are already present. And there's not a single.
But it's not only one way.
And
people have the ability to choose
at the moment.
People have the ability with their money to choose. If you say BTC only or Satoshi Vision only, you have that. That's entirely your choice. That doesn't make the decision of somebody else to use
How did that decision work out so far?
For some of these networks, it's worked. Look at M-Pesa. M-Pesa has been a huge. It's saved lives. It allowed, women didn't have to carry cash anymore. They were able to get paid. They were able to spend money. They were able to interact with their local economy. They're able to start businesses.
And get more credit and get more credit from the bank.
This gets livelier than a presidential debate here. I know there's a few other topics I want to get to, but I guess there's some feedback on people's open mics when you're not talking, and pretty lively conversation now, and I guess and other people's mics are open, so if you can mute your mics there when not talking. But I do, and that I'm not sure what I learned. I may be more confused now than I was almost an hour ago. There's obviously very different opinions about stablecoins. Actually, Peter's out in another ballpark about stablecoins. Sounds like, but I do want to discuss custody, KYC, AML, and the risk of sort of the financial responsibility in the crypto world as compared to the traditional asset world. We had in the 2008 Bear Stearns, Lehman Brothers went under, money was lost. I know funds that lost money at Lehman Brothers, or funds that got lost, and they're their prime broker. And one of the things I'm finding in the industry when I talk to hedge fund and CTA types, and especially family offices, when you have client money that you're managing, and they understand traditional prime brokerage. I have my prime brokerage at B of A, BAML, Credit Suisse, UBS, whatever it may be, and they do all my clearing and all the traditional asset classes. I get credit, and they do all my NAVs and stuff like that. Doesn't really seem to exist in the crypto world, and it's basically because Goldman Sachs doesn't offer clearing in Bitcoin yet, right, or digital assets, right? So it seems to be, grassroots movement from, independent parties in the industry, in that, we all know who the custodians are and the banks are that are involved in it and things like that. But if I'm a traditional asset manager and I want to get into the space, one, how is the best way to do that? In the workflow, custody, then there's a KYC AML, and a lot of these funds do KYC AML on the clearers they work with, on the exchanges they put money with, the vendors they work with, and there doesn't really seem to be that institutional level solution in the marketplace yet. So I'm just curious, one, starting with the safety and security of when people put their money someplace to trade. I got $10 million in client money. I want to trade my quant strategies, trading crypto. The question is how do I go about and do that? How do I get proper reporting on a daily basis? How do I get my NAVs? How do I know my closed P&L? How do I know my open P&L? What is my reval? Who's going to do my fund administration every month? There's all these questions, and where's my money going to go? I got a custodian, but wait, you have to move my money to an exchange. You have to do this, and there are solutions out there, right, that are trying to solve this, and they're close, and there are people doing it, and it's really good. But I'm just curious from the legal standpoint and other people's experience, Carol and Joel, your experience being in the traditional asset markets back then, what's the relationship now to then, and how does this whole work? How does this work?
I can jump in if you like quickly. I think there's one thing here, specific to the questions of how do you get your NAV, how do you get I think this is where, Joel said very early on, some of these players that have a lot of experience doing complex reporting structures and all of this stuff. When you look at Quantos and Bank Frick, BDO is the underwriter or auditor, pardon me, for their service. But basically what they put together is kind of a package service for private stablecoins. When you look at what N26 is doing, very, very, very similar in structure. There are also very different types of applications than what you see with Tether, as an example. So in those cases, you have a licensed chartered bank providing you these values, contracting the people doing the auditing, etc. But I think, in the US market, maybe rather than in Europe, I'd be curious, Joel, I know some of the projects, and Carol, you guys have worked with, there's a lot of different ways that reporting and this transparency can be done or can go wrong.
So I'll jump in here and say that I think it's dependent upon a couple of factors. One is what the investor or the buyer wants in terms of assurance around the product. Do they want custody with an entity that is regulated, that's examined, that's reviewed, audited to handle the assets, or are they comfortable just having it done by someone who has the capability to do it, but it doesn't necessarily meet any kind of regulatory standard? So that's what are the demands on that end. The second is then looking at the nature of the assets and whether a regulator comes in and says, hey, if you're performing that kind of an activity, you need to be regulated.
Yeah, like DBT in Singapore as an example, or the payment systems in Switzerland.
I know that Benjamin Losky has taken a lot of flack as the regulator in New York that got the BIT license off the ground. But when he started that process, it was really with the intent of doing some good for what he saw as a burgeoning asset class and industry, and it was to provide some guardrails that would lead people to be comfortable with doing business with this industry. And I think that's what we've seen over the last 7 or 8 years. I mean, obviously that's another story of how that played out, but over the last 7 years or so, we've done nothing but build infrastructure that is intended to try to make people comfortable in dealing with crypto.
And that's the most important point, because don't forget the history of this. If you go back to the early days and you look at this kind of libertarian anarchist approach, people thought, well, whatever this is, it's totally different. So we don't have to worry about things like reporting. We don't have to worry about taxes. We don't have to worry about account statements. These are people that are doing direct peer-to-peer transactions. This is outside of government purview. And at some point we all grew up and we said, well, wait a minute, no. To the extent you're investing and you're investing in an asset class, whether we call it crypto or not, the same concepts that apply to other asset investments apply here. Things like reporting for tax purposes, having a custodian that's managing and making sure that your assets are actually there. So all of the things, that Carol just mentioned, it's a good thing the way the industry has been evolving, and where we're going to now is a much more sophisticated ecosystem where there are players stepping in and saying, yes, we will help with the reporting. We will help with the custody. We'll help with managing the wallet. We'll help to make sure, that we audit and verify the assets there. All of the things that needed to happen that a lot of people fought against for many years are finally coming into play now. And I think it's a good evolution. And we've still got a long ways to go, but we've made huge progress.
Yeah, and I would agree. And I think, from one of the things, specific to the question around regulation, when I'm based in Vancouver, Canada. When you look at the history of crypto exchanges in Canada, we have the who's who on the wall of shame. Mt. Gox, Quadriga, Einstein, Van Beck's, the whole army of these different players that have kind of gone through these exact same structures. The money's all disappeared. There's no proof of reserves. There's no any sort of these type of concepts. And these are all things that blockchain technology itself enables. That in the traditional system, proof of reserves is always trusting somebody else to report and, did they reconcile overnight, et cetera, et cetera. Well, you see some of the exchanges now actually, providing that on chain, and that's a huge amount of transparency that they're opening themselves up to, and scrutiny, and potentially even competitors understanding exactly what's going on in their business. But I think they're doing it out of a sense of transparency and full disclosure. And I think we're going to see more projects that are doing, that move into this kind of using this open technology with these infrastructure, like, whether it's the back office firms that can support these type of processes, or even private market exchanges that start listing them. I think we're going to see a lot more with the advent of more stable coins in the market. We're going to see a lot more players being willing to kind of dip their feet and if you into the asset class, whether it's cryptocurrency or other applications of blockchain like digital securities. If I want to invest in a company and I want to have dividends paid out, to me on a regular basis as a cash dividend, am I going to put that back into fiat, or am I going to leave that and account for that on chain? Blockchain we can use as an accounting system. It doesn't have to be its own currency at all times. And I think that's something to keep in mind.
And by the way,
I'm referring to DLT right now to blockchain.
I'm an Ethereum guy. I'm an Ethereum guy, but people can use DLT. They can use whatever database technology they like. As a company, we're agnostic to your database technology. But
Peter, one of the things that you had said earlier in our conversation as to why we have stablecoins. If we ever get to the point where you can go in and out of crypto, between crypto and fiat, as easily as we can go in and out of other asset classes, then one of the uses for stablecoins may disappear. Because one of the reasons we do have stablecoins is because of the friction that exists right now between a fiat and a crypto investment.
The only reason we have stablecoins right now is because we're taking the easy route. Instead of creating the community, instead of investing all the funds by everybody who is involved into the community, creating the marketplaces that are based on Bitcoin or Ethereum or Litecoin or whatever, not being pegged to something that could be absolutely valueless in the next, 10 years, because all the currencies are dying within 100 years, within a century. We are taking the easy route and saying, you know what? Let's create an easy marketing solution, call it a freaking stable coin, tell everybody that's just a USD, has absolutely no value to anybody, centrally controlled, and let's try to make some money out of it. And that's really what's happening.
Yeah. I know, Peter, you're not a fan of stable coins. That's it's pretty clear. But I'm more concerned. I'm more concerned.
Stable coin.
So what are you fan of, Peter, besides
the best stable coin is USD. And we must realize the actual intrinsic value of USD. And it's not that they have gold bullion somewhere and securitizing that. It's not that they have pieces of paper that are being securitized. It's not that they have GDP being securitized. It's that they are backed up by liquidity. They're backed up by liquidity because they forced all the countries, US forced all the countries to transact and quote everything in USD. Because they created a huge marketplace where everybody has to exchange with each other using USD. So if we really want to create a stable coin with blockchain technology, we have to create a really liquid marketplace that is using that specific stable coin. And that stable coin might not be pegged to the dollar at the end of the day in terms of correlation. Might not be correlated to the price of gold or crude. Doesn't matter. But it's got to be backed up by real liquidity.
Okay. All right. Okay. Well, I'm not trading stable coins to make money. I'm trading Bitcoin and other assets to try to make money. Right. So,
and add into the
I'll worry about the liquidity when I have to execute. We'll just leave it at that. If I have $10 million, and again, I want to go back to what I think is a worry here. I mean, like I was saying, I know a fund who had $20 million at Lehman back in 2008, and it was client money. That money's locked up still, going through legal issues, right? And obviously, Lehman went bankrupt. So, and that was on a prime brokerage side of things. So, if I have client money and I got to go to a custodian or an exchange, how am I going to feel confident that I'm going to put this somewhere and have the workflow, the ecosystem where my money can trade in one ecosystem or as close to one ecosystem as possible, and feel secure about how to transact, and all the way down to accounts within if I just have managed accounts. And people are worried. They're very worried about one of these places blowing up, going bankrupt, or something going wrong, and their money is gone. They're worried about the reporting and the treasury. And like Joel, you went through it. And I'm just curious if you see the potential for that type of stuff in the crypto space, and what is the solution if you're talking to a hedge fund who has client money, or a family office has got a lot of money and they want to get into the space. Well, that's the biggest concern I'm seeing.
So look, I'm involved in this space. I live and breathe this space, and I believe in it. But at the same time, it drives me crazy that, when we had the elements of players that said that we're in such a new world that all the existing concepts of regulation and oversight no longer apply. That was nonsense. It still is nonsense. And so just because we're talking about a decentralized world and even peer-to-peer transactions doesn't mean that there aren't appropriate, and I don't mean over-regulation, but appropriate levels of regulation. The concept of protecting assets, the concepts of how we think about custody, about fraud, about assuring consumer interests are being protected. All of those things that we've always, thought were important in financial transactions, capital markets for years and years and years, apply here in the crypto and blockchain space the way they do everywhere else. And we're slowly but surely starting to implement an infrastructure that recognizes those things. And so, again, I'm not for ridiculous regulation, especially applying regulation that was written in the 1930s to what we're doing now. But I am a fan of acknowledging that if we're going to take the assets of individuals and custody them, that we should have fiduciary obligations, responsibilities that custodians are subject to the same way we do for other asset classes. It's no different. So we're getting there. We've still got a ways to go, but we are getting there. And I think part of that process of getting there is also going to expand the number of players that are willing to look at the space. For all of those of us that are heavily involved in this space and we think this is all consuming, it's a humbling fact to remember that the amount of transactional value that's conducted in crypto is minuscule. And part of that is because institutional money, all the amounts of institutional money that exists in the world are still sitting on the sidelines, and they're not touching the crypto space, and in part because they don't believe it's mature enough for them to put money into it without losing their shirt, because of fraud and because of stupidity and other bad actors. And so we're getting there, but we've got a ways to go.
Well, and also because those digital assets are way more decentralized relative to the traditional assets that those institutional players are investing in.
I agree, Peter, but I guess my proposition is you're right, but I'm a firm believer that decentralization does not mean that it's beyond any type of regulation. And again, I'm talking about appropriate regulation, not stupid regulation. But I do not believe for a minute that the fact that we've got decentralization means that regulation is both impossible and inappropriate.
But there is so much at stake right now with this whole with this whole regulatory climate, is because digital assets, and stablecoin is a great proof that digital assets are just becoming an app to the existing system, while the system has to be changed altogether. So how you have to change the system from the ground up. Instead, they're telling us how it must be regulated for anybody to, again, protect something from just because of lack of education, and now we have to deal with those regulations for no reason.
I would disagree that I think a lot of the regulations actually are there for good reason. In many cases, the original intent versus what happens can be a long way from the goalposts. But I do think, that if we look at the intent behind some of the regulations that have occurred in financial services have just stacked on top, from securities regulations to different currency and tax reporting, and we have FATCA compliance, we have CRS, we have KYC, we have logo or abbreviation soup, basically, just on the regulation side. But they all start, things like Dodd-Frank, or the way you see things happening in the U.S. now. They all were a response towards typically bad actors abusing the system, and an attempt as the way we've federated our society today is not purely decentralized, but it is not fully centralized either. People have a vote. People have the ability to, talk to local officials. What I think is really powerful about this technology is what it's going to enable when we start using this technology for things like our money or managing things like digital identity. How much more can we scale and move that level of power further to the leaves, further to decentralizing it, but it's still always going to be federated.
And how many
to some
how many
level.
people got penalized during the 2008 crisis from the CEO of banking, from the banking industry?
I'm sure you can dig
Only
those
one.
reports up.
Only
There's,
one. He cannot get hired by anybody, but he got a $200 million bonus. Right?
but that's,
Who got a $200 million bonus?
yeah.
CEO of Lehman. He just cannot get hired by anybody. But
CEO Lehman?
Yeah.
Well, I feel like we're getting off of the topic somewhat here.
Yeah.
Go back to the issue of, what kind of regulation do you put into place in this area? I mean, we have a history, at least in the United States, which is we have regulation typically because of crisis, where there's been a crisis, where there's been a problem, people have been abused in some form or another. And that's certainly how we got the rules in the banking industry. We've gotten the rules in the securities industry, in the insurance industry, and so on over time. It's going to be imperative upon the
Oh, I think you're on mute.
Have I been on mute the whole time?
Nope, just the last 3 seconds.
But over time is demonstrating how those guardrails are not necessary. I'm participating in a couple of groups dealing with governance issues, and how do you deal with, in a decentralized world, with the appropriate standards for governance, so that we can take those moves away from a regulated system where it's imposed from the top down and it comes from the bottom up.
Yeah. I would completely agree. And I think that, like you said, there's, these regulations usually come in response because someone's figured out how to exploit a loophole in a certain way. I would say, look at the Ethereum DAO and everything that unfolded. And then, they took essentially a regulatory measure. They, as an organization, they made a decision, and I do think that, this technology will continue to see different iterations. Some will be, the next Bitcoin. Eventually, the Bitcoin will go the way of the Deutschmark. Eventually, the USD probably, will as well. Like, we over eras, we move our value. At one point, Roman soldiers were paid in salt. Like, if that was their Bitcoin, and so we as a species, we continue to look for ways to preserve, to hold, and transact value amongst each other. And I think that what this technology enables in a lot of ways is for this to be done a lot more cost effectively on a lot smaller scales, local networks, or, and it's still not there. And to your point, earlier, how does an asset manager purchase this? Well, if you have enough cash, you can go talk to Fidelity. If you don't, you got to start, heading into the Reddit forums and digging around and finding out who you can meet somewhere to give some cash and get some Bitcoins. There's every layer between those two exist in this market. And at some point, people in the space or entering the space will need to have easy means of determining the value of, if I choose stablecoin one versus the other. And when you see even tools like Morningstar offering ratings on different digital assets, I think that's just another step towards, hey, somebody is looking at this and making it easy for the end user to decide, to make a decision. And it's always going to be, you're making a risk calculation. Do you choose money market fund from Goldman Sachs, or do you choose a fund from someone else? It's the same thing. It's, we're just dealing with organizations that we don't recognize the names of, as well as players like Goldman Sachs, but structurally they're very similar.
Sure. What I'm trying to say, pretty much, in response to your original question, let's say you have $10,000 of your clients and you need to make sure that they're safe. In this situation, if you are just a hedge fund manager with the old school system of information asymmetry, where you're offering a service, you're not educating your customers. You're only educating your customers about how to read the P&L of your trades, for example. And it's a great industry. It's a huge industry. So there's nothing bad about it. It exists. In this situation, you just have to go to the centralized exchanges, centralized crypto exchanges that are hopefully FDIC insured, to make sure that, up to $250,000 is insured. You can get the money back if anything goes bad. If there's some internal hacks, some external hacks, doesn't matter. Boom. What I'm trying to say is that's the old school way. We have an opportunity of a lifetime to make people think for themselves. The best way in this situation is not to go the traditional route of centralized exchanges, but yet to create a decentralized exchange that will be served by those truly decentralized stablecoins in that ecosystem. But that has nothing to do with trying to build up certain apps or trying to make overly regulated environments for the existing system and trying to stick completely unstuckable, stablecoin environment to the digital world. That's what I'm trying to say. Like, it's impossible to connect stablecoins or any other digital assets to the existing economy, because the existing economy is based on central economic system. That's what I'm trying to say.
I would say our current economy is incredibly distributed globally. Now, is the wealth centralized and accumulated? Yes, definitely. There's 65, there's always quotes going around, a certain number of people that hold the same amount of money as the rest.
Correct.
But that doesn't mean that when you're doing the reporting for your company that you're not contributing to that same economic ecosystem. If you do your tax reporting, you're also contributing to see all of that stuff go away. If you believe that that's where it's going to go, that's great. Bitcoin's decentralized. You're not.
If you are,
they can still come after you. And if you don't file your taxes, you might get a letter one day from the IRS wondering about certain cryptocurrency balances.
And taxes are defined again by the centralized government, and you don't know why the tax rate right now is this or that, because you're not making any decision, because the politicians decided for you. That's one. If you become a CEO of a company, the shareholder board will tell you what to do, and if you don't do this, they will find a way how to fire you. So, and they are the ones who control all this wealth. So again, the current economy, you said it yourself, is decentralized.
Where do you stash all your money? What do you own? I mean, I'm just curious. I mean, you like the government, you don't like stablecoins. I'm just curious. What do you own?
I am a co-founder of Ronin AI, and the company that is trying to go towards the DEX solution. Cannot reveal my cryptocurrency holdings. When it comes down to my portfolio, currently it is in USD because there's no better way at the moment. And what I'm trying to invest all my free time is try to build proper communities. And I'm spending, and the guys in our community will reiterate. When I wake up, the first thing I do is respond to all the questions. Before I go to bed, the first thing I do is respond to all the questions. Try to educate my community as much as possible about self-asset management. That's what our project is for. We are not here to make money. We're not here to create a symmetry of information. We are here to create an educated community that later on will be able to use those decentralized stablecoins.
And what percentage of the average person on the planet is able to engage in self-asset management like that?
Very tiny. Just like it's so tiny, just like the tiny progress that has been done by the stablecoins in the digital asset space. It's equal distribution of tininess.
So what does everybody else do?
I own U.S. dollars, right? I have some investments in some ETFs, some stocks, and that's what I own. And I'm involved in crypto, and I own some exposure to some crypto related stuff. That's about it. That's how I'm involved in the entire asset management industry in terms of my own stuff. So, but to me, Bitcoin, Bitcoin's got the liquidity, the depth, it's got the market cap. There's opportunity to make money there, and I'm not talking about, hey, I'm an anarchist and I think the world's falling apart and, I'm going to go buy some coin. You saw, Paul Tudor Jones came out a couple weeks ago, put 1 to 2% of his net worth because he thinks inflation's coming. You got Mike Novogratz and Galaxy saying the same stuff. And, I'm glad it gives some relevance to, gets the word out there. And you can't have any two bigger people in the world, in terms of hedge fund stuff. But, hey, I look at Bitcoin as an opportunity to trade and make money. And I don't care if it goes to 10,000 or 100,000, or if it goes to, well, quite frankly, I don't want it to go down, because if it goes below $1,000, it's probably gonna be pretty bad for the entire industry. My bias is it goes up, and I want it to go up. But I just view it as an opportunity to make money. And I think there's a lot of people out there that view it as an opportunity to make money, and they're not anarchists. They're not saying, hey, the government currencies around the world are going to go to zero. We're going to have massive inflation. And some want a little bit of exposure to the space. So,
and we need people like you. True. We need people like you. We need somebody who will increase the liquidity of the current ecosystem. Although you don't necessarily want to hold BTC, you're not necessarily believing in decentralization, you think the status quo is fine, you don't care about this, you just want to make money, you just want to exploit current volatility, we need people like you. Great. Just like in any futures markets, you have hedgers, you have speculators. Speculators are necessary, absolutely necessary. They do add value to the hedgers. But again, the whole situation is we need to change the entire ecosystem. Just trying to use old school.
I don't know. I guess, yeah, I don't know. We'd have to get into it, but have you written your white paper on how to change the entire ecosystem and reform and change the world, Peter? I don't know. It sounds like you have.
Satoshi had. I don't
I'm going to put my money on the Libra project, because the Libra project is going to drive the largest number of people globally into the use of the technology that will then act as, if in fact Bitcoin is going to be, or a cryptocurrency is ultimately going to be the best form of currency, it's going to drive them there eventually.
I would, from my perspective, I invest where I would say I still invest in more of an old school approach to value. So several startups as an example that I've been involved with, as well as some cryptocurrency, and then of course always keeping some in things like CAD or USD, but in some sort of a liquid position. I'm a very boring follow the old school thoughts like rebalancing rather than speculatively trading, because I don't have time to watch my balances on a regular basis. And so, it's not something that I do. And if there was, I think as things modernize, I think it'll get to a point where you'll have the asset managers that can take this work off of people's hands, and people won't want to do it themselves. Others do. And that's the cool thing about the technology, is that there is always the choice to directly engage, go straight to that Bitcoin node or Ethereum node and start right there. Or call your, as this continues to move into more of the mainstream. And I think things like Libra, it's interesting. Libra has a ton of potential, but I also see a huge amount of regulatory challenge ahead of the road for them. Even from the concept of, how they've kind of approached things like KYC AML as an example. Their Facebook's approach and their architecture of the entire system, demonstrates Facebook's perception of personal data hasn't changed from Facebook as a platform, and Libra is just an extension of that. And so I think there's going to be a lot of people that will maybe not engage with Libra just because they want, they would like more privacy like they have with US dollar than they would have with something like Libra. But it is interesting, from seeing how they will navigate that. There's a huge amount of people in that project. There's a huge amount of organizations behind it. And as a shared network of value, I would love to see what the economies, the metrics within the economies of scale would look like as that project were to gain users. There's 2 billion people that could become providing liquidity to Libra, over the course of a rollout period. So, if you're looking for things like, if liquidity is the only thing that, what if someone else will pay me what I paid for this is the only metric of success, Libra is really poised to do very well, because just they have the access to the distribution.
Right. So don't want to put words in people's mouth. Nick Spanos is trolling this Libra project. I was trolling Libra project since July 2019. I still don't understand why the hell we need that project. I think the only reason why we need that project is because Facebook has nowhere to grow. They failed to distribute the internet to more users, and they just need to allocate $50 billion in cash.
Well, okay, before Joel answer, I was just about to say, before you said that, Peter, I think I may be only one of 10 people on the planet who has never had a Facebook account or even barely even looked at Facebook. So I don't really understand the whole, hoopla of Facebook. I know people who do it. I've never gotten on it. But what on earth what is a Facebook Libra stable token for? I have no clue. And when they come out, they say they're going to do it. It's not Amazon. I'm not buying stuff on Facebook. I don't know. Am I missing something here? I've never been on Facebook. Don't have an account, so I have no clue what a Libra Facebook token is for.
You didn't lose anything, Tour. Don't go to Facebook.
You're in good company in that area, but things like
sorry,
go ahead, Carol.
Get Libra. You'll get it through. You can get it through many of the other players that are going to be involved in the Libra Association. So having a Facebook account is one way, but it's not the only way. And I go back to my example early on. If you get five Libra in your Uber account, are you going to use them? And then what if the next time that you go to use your Uber account and they say, hey, if you use Libra, it's going to cost you 20% less for a ride than if you use your credit card transaction. We have a long history of privately issued currencies in the United States and worldwide. There's a whole system of community-based currencies that exist today, sort of a barter type economy. Experimenting with currency is nothing new. It happens that the crypto is on steroids and has a lot of interesting potential. But Libra is taking a combination of the old and the new and trying it out. And if you just take a small percentage of that 2 billion, you're going to very quickly have more users than we've seen in all of Bitcoin over the last 10, 11, 12 years.
Carol, how is that sustainable? How is that sustainable to offer discounts for somebody to use it? It's like me offering to grab somebody, for some kind of show, just for the sake of buying them, extra money. Like, it makes no sense. It's not sustainable. MySpace also had a huge audience, but died out.
Acquisition cost and the cost savings of using that shared payments ecosystem, which is all it is. It's a shared ledger for payments.
I can tell you so many projects met you.
PayPal and Uber and Facebook. So if I want to, further to your question, I can go on Facebook and look for a bicycle or a car. I could walk up to that person and say, yeah, this looks great. And I could just send them the funds and walk away with the transaction, not have to wait for an e-transfer, anything along those lines. So I think there's going to be, from a convenience perspective, the technology has a huge amount of convenience opportunity. And, what we've seen, if anything, from the internet is that it's not always the best technology that wins. And it's not always, the best interests of everybody that win. It often comes down to.
All right. So don't forget that strictly a distribution model, and then they get the Ubers of the world in, and they basically go to, I don't know how many billions of clients they have, and just say, here, I'm gonna just stack you. I'm gonna put into your account X number of Libra, and I'll go spend it. So I didn't realize that. So,
but that's part of. Look, don't forget that for Facebook has WhatsApp and Messenger. And Facebook is looking at, players like WeChat and Alipay and saying, wait, we've got these messaging platforms and we are not using them in the full way we need to be, which includes being able to use them as payment platforms as well. And so Facebook in part wants to be able to monetize better WhatsApp and Messenger. And a great way to do it would be able to add a payment feature that utilizes its own stablecoin. Now, if Libra never comes into existence, Facebook can still monetize and turn WhatsApp and Messenger into payment platforms like other players have done in other parts of the world. But they're looking at part of this as being a monetary and technology play where their own stablecoin would allow them to create all kinds of efficiencies in turning those messenger platforms into also payment platforms.
Absolutely.
That's what I think is what's driving it.
Fully agree. And, Facebook has been working on this since before 2015. They've been working on this, and it's been there's been multiple iterations. I had the opportunity to go to school with one of the guys who was in the early days working on the project. But what we've seen since then, that was back in 2016, what we've seen since then is that they've moved from the concept of having a messenger coin to the concept of Libra Foundation, and kind of creating one iteration to now kind of what the 2.0 that they've proposed. You see where they're heading is to, Facebook has the ability to be one of the only financial institutions in the world that can offer global payment services in this network for free, and live off the data, and turn that, that transactional data is way more valuable.
That's exactly it.
The payment processors still take a slice of a transaction. And that is the opportunity that Facebook has, is they don't need a slice of the transaction with Libra.
So I remember, I read this book, I don't know, 10 years ago called PayPal Wars or something like that. It's talking about when PayPal first started, and the whole direction of PayPal was, I don't remember. It was like, it was almost like Bitcoin back then. It was like they're talking about, getting money out of, some country and moving it somewhere and all that kind of stuff. But then they started noticing this thing called eBay, where people started accepting, PayPal. You pay for your stuff using PayPal on like eBay and stuff. And that was person to person. It was, instead of one to many, it was many to many in terms of transaction. One to many is, I have I can spend it on Amazon, Uber, or whatever, fine, on a business, but I couldn't really use it with anybody on this platform right here, right? Unless you were willing to accept a Libra. Right. But then what really took PayPal over the top was, all of a sudden people said, hey, you can pay me via PayPal stuff. And that really started to help the whole PayPal thing. Will this, consumer coin from person to person need to take off before? I mean, quite frankly, if someone gives me 5 Libra and I go spend it on my 5 Libra on something, when that 5 Libra is gone, I'm probably not thinking about going buy more Libra. I'm only spending it because it got to me, and that's maybe just me. But maybe if there's some utilization outside of spending it on an Uber, where I could say, hey, I'm going to buy your 2012 XYZ car, and I'm going to pay you in whatever.
Yeah.
Well, the critical issue of currency is getting adoption, getting into circulation. So if you look at the numbers for Tether, if you compare the numbers for Tether against Bitcoin, Bitcoin, only a fraction of the total amount of Bitcoin circulates on a daily basis. If you look at the numbers for Tether, it's I don't know, 10, 20 times more than the amount of Tether.
Oh, I think are you on mute again?
Talking with my hands here. In the context of Libra, it's getting whatever the initial amount of Libra that's created as a result of their mechanisms for creation. And remember, Libra is not just Facebook; it's a whole bunch of different players. But if you start out with 10, but you can have that 10 circulate 10 times or 100 times in a day, you make that 10 a lot bigger ultimately. And that's what we're talking about. So that, at some point, yes, you may get paid by someone for your car in a P2P transaction. Then whatever you make from that, you go and you can spend on other places. And it's a circulating effect. And that's what really is a distinguishing factor with a currency.
Yeah, and I think to his question there, like, if I get 5 Libra, like, perfect example would be, the Uber dollars, or you see with, some of the other rideshare apps where they have, hey, if you have $5 to spend there, of course you're going to spend it. Does that mean I'm going to go and buy that, top up my Uber wallet? Not a chance. Like, why? For me, there's no reason. Some people do use it in that way. I'm not sure what the application is, but some people do. I think what we're so early in this, and I do think, I was just seeing some of the comments here, I think there is really valid reasons to be concerned about how some of these networks, even like how Libra, comes out, looking at it from a privacy perspective, looking at it from your personal data perspective, just even at their architectural designs between where does the data sit on the blockchain and who has what information housed in what repository. can give you a really good idea of things that we should be monitoring with a large network, a corporation issuing their dollar, their digital dollar, and creating their internal GDP within their platform. Is something I think we have to be really really cautious about. And it is definitely, I've seen a couple of comments here, and I would definitely agree that it's something that is not necessarily what people had originally thought would be an application for even DLT or blockchain. But I think it's going to continue to go ahead, and people are going to do it. Would I, as an example, become a user on Libra? Not unless it was another one of those scenarios where maybe I can save $5 on an Uber ride. Do I want to give my personal KYC identity to Facebook in order for $5 on an Uber ride? Personally, I wouldn't. I'm very careful. I'm very, very privacy centric as a person. So I wouldn't take that, because that is what you're giving up. And it's a data game at the end of it. And so I think whenever we see some of these, whether they're state-backed coin projects or other projects, I think it's really important to look at the technical architecture, because it's about trust, whether that's trust that you think it's going to be worth $1 today and $1 tomorrow, or whatever unit of value you're measuring it against. That's only one layer behind it all. I think there's a lot of other lenses that you need to decide if you want to trust any new technology, just like a new financial instrument that might pop up in Wall Street tomorrow.
Guys, you keep referring to Libra as a currency, as a digital dollar. Let's just call it loyalty points. And Facebook loyalty points program is a great program. I'm all for it. But since we got two supporters of Libra, Carol and Matt, Joel, I think, Anna told me that I think you could, what is your view? Because I would like to trash Libra as much as possible in the next 5 minutes. So can we do it together? Is that a possibility?
How familiar are you with their code?
Very familiar. Non-existent.
I was just asking if you what would you see as the primary concerns with Libra as a technical solution?
Not as a technical solution, as a ecosystem solution, because a technical solution never comes first. It's always the architectural solution that comes first. Development is super easy. So there's absolutely nothing that Libra adds to the table. Zero. Visa and MasterCard are already doing what they're doing. And we also must realize why Facebook is not allowed in China. Because China is so bad? I don't think so. I don't think that's the main reason. Because China realized the importance.
No, I think there's a long trade history there that's much bigger than just whether or not China wants Facebook. I think, and that it's interesting bringing China up in this, because on that same note of technology companies on either side of the U.S.-China equation, and you want to talk about digital things like stablecoins in a more true sense of a central bank issued coin, players like Huawei, this is a major focus for them as well. They run the mainframes for about half of the central banks in the world. And so, this type of accounting technology is a big consideration for a lot of different players. I don't think it's reasonable to expect that a few people who want to see one iteration of the technology will stop people from applying this technology and changing it and making it more, more centralized, or more something like a Hyperledger iteration versus a Bitcoin iteration. Is a huge difference. People often see them as both blockchain, but they're not.
I don't see much excitement about making the existing system even more centralized. I just don't see how this is exciting. Unfortunately,
Peter, I think there are several misconceptions in what you put out just a minute ago. One very important one is loyalty points are, in fact, a form of currency. A currency is a medium of exchange, it's a unit of measure, a store of value, and loyalty points can very, very much be a kind of currency. I think in terms of it being, again, you keep calling it a Facebook project. It's not just a Facebook project, and there's been some very interesting hires that they've made in the last couple of weeks for the Libra Foundation.
Yeah, absolutely.
So I think it's an incredibly interesting experiment in money. I also watch it probably from a slightly different perspective than most, because I spent a number of years involved with a gold-backed digital currency system that had a significant amount of adoption by the middle of the 2000s. It ran into some issues with the federal government. I got hired to work with them on the backside of the issues. And if I were to call it a stable coin, I spoke with the founder the other day, and he abhors the comparison to a stable coin, but it was a gold-backed system that was being adopted. And when we were working on bringing a new iteration of it out in the mid-2010s, we had the Facebook plan, the Libra, I should say, the Libra plan. We had it. We would have loved to have had an Amazon as a partner in moving forward with that, because that's exactly what you needed to drive the kind of adoption to make it a successful currency program.
Yeah.
So
I wouldn't.
Just real quick. So, I mean, it's kind of one. I apologize. I'm gonna have to run here. I'm not turning my back. I am listening to what everyone is saying. I do watch the trading desk, and we are pretty active 24/7. So I do certain things at the time of the certain times of the day, with set 8, 9, 10 o'clock being one of them. But here's the question. So I've read stuff before where some people think that Bitcoin was born out of the global financial crisis of 2008, right? Wasn't the paper written in 2009 that it came from the financial crisis and the banking crisis of 2009, and that's where the concept of this blockchain and Bitcoin came from. Considering what's going on in the world now, with basically the entire world on some form of lockdown, economic numbers plummeting, 30 million people unemployed in the United States, whatever it may be, we all know what's going on. Does something come out of the crisis we're in now to drive adoption in any coin, any technology? And at one point, as someone just asked this question in the chat here, and I'm curious too, is there a point in this whole ecosystem that says, this was a failed experiment? I mean, is Satoshi sitting somewhere with a button saying, I'm going to hit the button now. The whole blockchain is dead. I'm taking all the, and Bitcoin is going to evaporate into thin air because I hit a button. At what point does someone say, it's not taking off, if that is even a realm of possibility? Or does something come out of this crisis we're in and adoption grows that much faster?
Well, you're still thinking.
Are you talking blockchain technologies or just crypto?
I'm just talking about anything. I say, like I said, I read some stuff that, some people say the whole concept of blockchain and Bitcoin, came out of, the financial crisis of 2007, 2008, and trying to get away from the risks there. So they came out with this concept of Bitcoin and the digital ledger. I'm just saying, so if we're in a crisis now, and maybe it's worse, depending on your circumstances, does this drive adoption in any form of a stable coin, of a blockchain technology, whether it's banking, pure banking, or people getting their government subsidy checks, and instead of getting a check in the mail for PPP or something, they get some digital transfer? I don't know. I'm just curious if something comes out of this in that respect.
Are people getting PPP via paper in the U.S.?
Yes.
Okay. Interesting. To my knowledge, everything in Canada is pretty much digital, and for things like that. Sure, they could use blockchain, but I think one of the things that's there's still a threshold of technology readiness. Different people in different parts of the world, whether it's internet connectivity, whether it's the capabilities of their cell phone, or does their cell phone even enable a digital wallet on it? These are all kind of pieces that are still, the ecosystem is still very, very raw, very, very fresh. But I think one of the things that this new landscape, everyone working from home, et cetera, has really, for us, and for a lot of our clients, has really started to open people's eyes to, including regulators, is why do we necessarily need to have paper documents being couriered back and forth? Why do we necessarily need to have notarization being done in the way that it was done before? And when we start to question those last mile entry between the digital world and the physical world, and figure out how to actually solve those pieces, and we're having to face that now with everyone being in lockdown and quarantine, there becomes a risk towards having even being the person that issues the paper share certificates that move from person to hand to hand to hand. And there's also risk, the same thing with cash. So I think we are seeing right now, regulators are looking at technology with a little bit of a different lens, as a bit of a, how do we maintain safety, security, operation, business continuity in the market, and using some of these technologies that before maybe they weren't quite as open to. And the number of law firms, or lawyers, friends of mine who've sent me from different parts of the world briefs from their law societies focusing on e-signatures as one example, and the acceptability of these because of COVID. I think there's going to be a move towards digitization, and then we start deciding what tool. And is it a decentralized database that we're using? That's just one way, one type of adoption we'll see. But I think it's a rising tide floats all boats. Everything digital is going to see greater adoption, greater testing now, because people understand that there is actually inherent risk we hadn't considered in physical assets, or physical documentation of assets, maybe.
Come on,
I
Peter.
found it interesting watching just the general discussion over the last several weeks, and those who were Bitcoin maximalist over time, seeing this to be the ultimate disruptor of governments, central banks, and so on. That dialogue has been a little bit tempered, because I've been struggling to figure out how could you take in a distributed, decentralized world, come up with the kinds of solutions that we've been forced to come up with in the last few weeks. Now, whether those solutions are going to be our ultimate economic undoing, but between here and there, we needed something to be done very quickly. So I think we're going through another period of introspection with respect to the concept of Bitcoin, of cryptocurrencies generally, and the kind of role they're going to play on an ongoing basis. I separate that from the technology, and I think Matthew just did a very nice job of summarizing the fact that what has been unleashed from a technology standpoint and the different types of solutions it has to offer has been incredible. And I think we're again in the early stages of seeing how that's going to ultimately play out. In the meantime, I think we're really sort of 20 plus years, 25 years now into this era of digital currency, with Bitcoin just being the last 10 to 12 years of that time period, really, so probably more 10. It's that we're going to continue to go through an extraordinary amount of experimentation as time goes on. And personally, I find it all to be incredibly fascinating to watch and be a part of.
Absolutely.
Joe, would you like to jump in? And then I'll pretty much be honest with Tira's question.
But you want to go back to trashing Libra, or you want to do something else?
Let's trash Libra first, and then respond to what really happened since 2008.
Well,
I don't know if we have enough time. I don't know. I got to go here in a second. We're gonna have to have the Peter show coming up. Conspiracies by Peter. That's the next one. So, but now I'm listening. If I turn my back, I apologize. I'm not turning on you or the audience. I do have some simple math problems I need to solve to send on to trading stuff. So,
Conspiracies by Peter go like this. The Peter show.
Well, if you go all the way back to 2008, what were some of the cracks in the system that we still haven't really cured? And it's issues with respect to transparency, with respect to being able to transact in a way where we trust people and we know what's going on. And some of the early concepts underlying blockchain technology and the economic incentive system that was created by Bitcoin were designed to try to address some of those problems. And we have these, I love these debates that we have, but one of the things that would be helpful for us to remember is one of the older guys here, and I'll admit it, I'm an older guy here. But one of the things to remember is that we're still really early on. I still think back in like 1995 when I was coming home from work and carrying my 8-pound laptop and thinking how cool I was because I actually had a laptop, and I didn't give a damn about how heavy it weighed. And I'd come home, and I was married at the time, and I'd say to my wife, "Get off the..."
Or how much it costs.
Yeah,
or how much it costs.
Well, thousands of dollars, but I'd have to say, "Get off the phone," because I need to, plug into the modem and dial up to wait 10 minutes for my page to download. And so when we talk about where we are in crypto and where we are in blockchain, to me, we're still in that dial-up stage of internet. We've got a long ways to go. But what's really cool about this is we are slowly but surely reinventing the way that we can interact with each other and transact with each other such that we can definitely improve the problems we've seen in the past as far as too many intermediaries in the middle sucking out fees and costs without adding a lot of value, and too much, and too much lack of transparency in how we deal and transact with each other. And so we're slowly chipping away at that and getting there, but we've got a long ways to go.
Mm-hmm. Mm-hmm. And there's definitely there's a need to build before the gold rush. There's rails, there's whole towns and etc. in that analogy. It's so early that the amount of money in crypto or in stable coins across the board is so tiny. It's not even a blip on a lot of people's radar. It wouldn't be a blip on a lot of people's radar if it wasn't for the PR, that happens because of the community. And I think that's where we're going to see a lot of that continued value and continued trust go. But we are, when you said that, Joel, I heard the 26K screeching in the background, and we've come a long way now to where we have people live streaming on a call, and that's no different than this technology. It's the idea that the first white paper and the technology that came from it was going to be the consummation of all humanity and financial engineering ever. I don't think that that's true. I think we're going to continue to see amazing innovations that we can't even think about. This is reshaping and will reshape how we transact, how we store value over the long term. We are in those super early days.
All right, so let's go. So
I apologize, guys. I'm going to have to log out here and do some end of day trading work type stuff. But it was a great conversation, and we had I think I had a great group here. And I'm not sure what I learned, but I heard a lot, and it was a very lively conversation. And if we had another 2 hours, it could go downhill real quick. But it was really good. And I want to thank Anna and the Block Center guys, folks, for doing this. And I'm gonna have to say adios. And it was a very pleasure. And I hope to chat with every single one of you independently after this, because I love to talk more on a more personal level and business level and see what's going on, and then maybe we find ourselves back on one of these in a few weeks. So
absolutely, thank you so much for having us.
How soon is it before we can do this all together in a bar?
I'll see you there.
We really need to do that. We got to set a camera up. We got to have the fires, the fireside, crypto and cheese and wine and prosciutto, corner, and discuss this. And we'll do it very civilized. I can see it going down real quick if we're at a bar and there's alcohol involved, and it can get pretty heated pretty quick. But we'll keep it civilized. It'll be good.
As long as you don't mention Ripple, it's gonna go civil. All right, guys. Thank you so much.
Geez, we've got 2 hours without mentioning Ripple. I'm going to mention Libra all day long. I'm going to get a hat that says Libra. Leave a Libra just for you, Peter.
Cool. All right, Nick
Awesome.
Spanos.
Take care,
All right, guys.
Thank you.
Thank you.
Guys.
See you guys.